Peter Goodburn.
Yes,
Great.
I'm here.
All right, my buddy. My trading
Well,
warrior brother, it's great to have you back.
yeah, apologies for the slight delay.
Ah, you know, it's live TV. We can be flexible. Okay, so Peter, I want to start off by acknowledging the great call you made on yields. You were negative yields when it wasn't fashionable at 4.5%. People are even talking about, well, maybe the Fed needs to hike again in that period. And back then, you had a count that would take us down to 3%. It seemed very aggressive. Now it seems realistic. Great work, Peter.
Thanks, Dale. Yeah, I'm actually sort of looking at the 2-year yields over the weekend, and they're getting very close to reaching their numbers. So I'm just scratching my head a little bit, thinking, wow, the 2-year is getting to sort of some interesting fib numbers. Let's put up the
Yeah,
2-year.
yeah,
And I'm just thinking, well, how can that be? At this point in time when the Fed are just cutting rates and everybody's expecting sort of further rate cuts. But it looks a bit like this. These are the downside targets that we had at 3.4%.
okay. You're
And
not
that's the,
sharing yet.
I'm not, oh, sorry. Let me
So
just,
you hit the share, it's the bottom button, share screen.
here we go.
Yep.
I think this is going to be the right one.
Yeah, there you
Can you
go.
see the 2-year yield?
Yeah, got it.
Okay, sorry about that. Yeah.
Yeah,
Yeah, this is the 2-year. What we've just been talking about is the 10-year, this one,
right.
going down to 3%. And of course, this has still got some way to go. This target, by the way, for everybody tuning in, was just derived by extending primary wave A down to 378. So that's the October-April drop,
Right.
October-December drop by 61.8%. So that's a sort
Yeah.
of a standard measurement that we'd use for a C wave decline. And we applied the same measurement to the 2-year yield. So we've taken this same decline down to 4%, 412, extended that by 61.8. That derived 340. And as you can see, we're within touching points now. We've only got 20 basis points ready to go. And that's a very interesting
That would
scenario.
argue for another inversion right when the market was starting to come out of inversion. That there's
Well,
more upside in the long further out you go
mhm.
because there's still capital gains, where the short end of the market is almost there.
Yeah, I mean, I've also just had a quick look at our 210 analysis on the spreads, um, and have a look at this. Here's the 210s. We had a target some time ago going up to
Yeah,
about. It's exceeded it slightly, but the wave pattern is still secure. It's 5 waves up from the inversion low of minus 111 here.
right.
1, 2, 3. Nice triangle wave 4, 5.
So we go
And
negative one more time.
yeah, it looks like negative one more
Yeah, okay.
time.
All right.
And a pullback to wave 4 proceeding, which is normal. That we bring us back down to minus 50 basis points again. So that's quite interesting. And I mean, just at the point where everybody's starting to think in terms of continued rate cuts and what that means. I mean, this either suggests that the market's already pricing in enough for the moment, and
Yeah,
some of the data might come through in the next weeks, which is a little bit.
sticky on inflation. Or,
Yes.
huh? How about
Yeah,
that? Yeah?
yeah, a little bit
Okay.
sticky. And they might sort of then sort of like defend, stay put until the end of the year. And we start
Okay.
pricing in, we start pricing out, I'd say, a little bit of what we've been pricing in.
Okay. Because I mean, the question I have to my mind, I think we could go to the 10-year 3%, but what that's implying
Hmm.
is that our next move is into new high ground. What could be, and I'm trying to think what could drive that. And I don't think it's going to be strong economic growth. It's just going to be supply. So could we have a weak economy and on top of it, a weak bond market because we have a weak currency and money flow is out of US dollar denominated assets?
Yeah, well, we've certainly got sort of the dollar index sort of in a downtrend. I mean, this is the current analysis.
Yeah, you've been pretty accurate on the dollar too, Peter. You've been there for most of the turn, so nice work on currencies
Yeah, thanks. I mean,
and the metals.
yeah, I think the pattern on the dollar index has worked really well because we've seen going back to this October 2022
Yeah,
high, we saw a nice 5 wave drop, a nice expanding flat for wave two, a new impulse decline, which began actually intermediate wave one in the larger context. So this is minor wave one of one, and the second wave was, as you can see here, nice 3 wave recovery up to 106.51. That was
yeah,
April, I think.
yeah.
And then we're gradually working our way down now. I mean, it's not getting quite
It's
as
pretty
aggressive as this
orderly.
decline. Yeah,
It's
it's
pretty
quite orderly.
orderly and
Yeah,
choppy.
and choppy too. Yeah, it's I mean, we've got lower lows, lower highs, so that's the definition of a downtrend. From an
Right.
Elliott wave perspective, the downtrend is obviously a bit more detailed because we're looking at 5 wave impulse declines and successive degrees of trend downwards, which is basically being adhered to. So overall, the implication here is very much dollar declines. I think my
Well,
line of thinking.
Trump wants a lower dollar. Okay, they're already talking the dollar down. Now, so I've been with you on the dollar. Does that make you nervous, Peter? Or now there's more company than there was at 106, 107. And how does an administration get a lower dollar if they want a lower dollar?
Doesn't seem as if they need to do much at all, really, from
Yeah,
the pattern
right.
sequence itself. I mean,
Yeah,
the only thing is, of course, the mindset of the market is very different to what the Fed is orchestrating. I mean, basically, if we go pre-financial crisis, we had a Federal Reserve which was very much playing the game of Paul Volcker in previous eras, where the Fed kept its cards very close to its chest and didn't reveal much. Ever since quantitative easing was produced, they're now telegraphing ahead of time what their intentions are. So they've become very much more transparent than they've ever been in the case of history. And more recent years since pandemic, they seem to be basically following the data like each of us.
well,
they
I
don't
mean,
they're
I
not very
think the Fed
preemptive at all.
didn't the Fed follow the market. The 10-year was saying they were going to cut. They were way behind where the market was. So who
Yeah.
really leads? People think the Fed lead. They made a big deal out of cutting a half, but like you showed on the yield chart in the last year,
Mm.
we've gone from 470 to 320,
Yeah, I mean
350.
that's the case. The Fed are not really being preemptive at all. They're
No,
being very reactive, which is the
right.
worst. As you know, being reactive is one of the worst things you can be doing if you're trading. Um, you know,
Exactly.
you've got to be preemptive. You've got to anticipate. You've got to forecast changes ahead of time, and it's no good responding late into the session. And in a way, what the Fed have done by hurrying through a 50 basis point rate cut, it's almost as if they've gone into panic mode. Like buying the top of a market or selling at the bottom. Exactly what the opposite you should be doing.
Okay.
And that's also triggering my sort of contrarian situation, especially when we are coming to
Yeah.
sensitive 61.8 extension numbers on the 2-year Treasury yields. So the Fed are really doing it all wrong, really. I mean, they're not giving the market any surprise action, and the market's actually eating what they've produced because the market's mindset is very much tuned into what the Fed are saying, and yet the Fed are reactive. So it makes the market reactive. So if you cast your mind back to December last year, when we had sort of yields very much higher leading up into this period,
Yeah.
um, the yields were actually dropping down, and everybody said, yeah, the yields would continue to drop. I think the Bank of America sort of
Right.
surveys were saying there was
Right
I think
before
it was
they
something
turn.
like an 80% probability that yields would just keep dropping. And that was the highest on record in the survey, which suggested, of course, from a contrarian point of view, that yields would actually go up, which they did. They went all the way up here
Right.
from 4% to 5%. So
They have to
No,
blow them out, blow their credibility out first.
yeah, well, I think we already know that.
Yeah.
I think
Banks
some
are
of the
good to fade. Some of them. Yeah.
yes, I think there's something. I think there's something which will happen probably in
All right.
October in the stock market, which might give us a bit more clarity over the interest rate scenario,
So you
because
don't think they could hold it together for your B wave until after the election?
it does seem that way. Because I think there might be an intervening. When is the election? November when? November 3rd or something?
I'm
What
not
date is
sure.
it? Yeah, I think we have to check that, but I think it's something like that. But I think that we're going to get an October high here on the S&P, and most of the other contracts like the NASDAQ and the Eurostoxx 50 that we're tracking here in Europe. I think we get that sort of B wave nudge to the higher highs, and then we get a drop. That's about an 18% decline. I think the on the
You know,
NASDAQ.
a lot of people will turn bearish, taking out the April low, July low.
Yeah, yeah, that that
That
that early August low. Yeah.
yeah. Before that, they'll turn negative, but they'll get pretty negative there. Okay.
Well, at the moment, the of course the mindset is lower rates and continuing and so on and so on, and so there's a bullet. I mean, I think practically every investment bank between last Thursday after the follow up of the Fed cutting rates and now have come up with revised targets for the S&P much higher. Some
Yeah.
have said, right, well, Goldman Sachs I think have said, right, well, after a rate cut like this, if there's no recession is the big if. We're going to see history says that there's going to be a 17 to 20% increase in the S&P 500. And Deutsche Bank last week said over a 2-year period, if there's no recession, again, there's that sort of that provision, then the S&P will rally 50% into the end of 2026. That's going to go even above some of the big long-term upside targets that we have.
So you
Um,
always had, um, wave a pullback, like before you were looking for about 3,000. Okay, but you always had that new high of 7,400 coming into the S&Ps. Okay, I remember those numbers better. The only difference is when you saw what happened after the July peak, and I believe you thought it was only 3 down, that your idea of a pullback into the fall, that narrative had to change. You saw something that changed it, and you did, and you didn't fight the market going to new highs, and you had these numbers up there. But let me ask you this as a trader, Peter.
mhm,
When you have a narrative
mhm,
that you have conviction about and you
mhm,
stay with it,
mhm.
and then you have the authenticity to say you're wrong, there's a different count happening. What mental process do you go through to be able to make a turn in a count, even though it's really the same count? The only difference is from where it started and the levels.
Mm.
Um, do you think about opportunity costs because your count, what you were looking at the other side of the market, rather than being long with the market? What do you go through as,
Mhm.
I know you have institutional clients, you have a lot of people that depend on your work, and you depend on your work. You trade your work. So,
Yes.
what do you go through your process as a trader when you have to shift a wave count that perhaps you've believed in the
Mm,
narrative of that count for many months and then have to
mm.
turn?
Well, the narrative change and the mental process is quite significant, actually. It's not something we take very lightly because
Yeah.
we do a lot of cross correlation analysis in order to come up with a theme anyway.
Right.
When we started looking at the way in which the 2022 decline occurred, we had a lot of inconsistency and overlaps in those declines. And more so, when we take a look at, say, for example, um, the pandemic advance in the S&P and NASDAQ, and also we've got some very good ratio relationships in the Dow Jones futures from the pandemic low. They all showed a consistent 3 price swing event up ending into the Jan. It was either November 21 for the NASDAQ or Jan 22 for the S&P, down, things like that. Also for shares like Microsoft and one or two others. And this gave us a bit of a tip-off at the time that the advanced or intermediate wave 5 from the pandemic low wasn't going to take a conventional 5-wave expanding impulse pattern. You know, for those tuning in with Elliott wave knowledge, a typical 5-wave expanding impulse pattern would look something like the one on the top left-hand corner here. This one. I think many of you might be familiar with that pattern. You see typically a 3rd wave expansion in the 3rd wave. So it gives it this generic sort of 5-wave impulse. But that's only according to the fact that, you know, the initial swing up from the pandemic low was a 5-wave pattern itself. But we only saw 3 waves, and we kept on seeing that repeated over and over again. So we started to adopt the diagonal process, this one, and that required a very deep correction. And so we analyzed the authenticity of that deep correction, and we came up with inconsistencies in the decline into the October 22 lows, and said, well, we think that there's going to have to be a much deeper correction, because we were only 38% correcting in that phase. That's pretty small.
Yeah.
As it's turned out, we've gone through the process and we've adopted this one, which is the expanding diagonal. And the expanding diagonal doesn't require such a deep second wave correction. But the only reason for that is because when we started to look at the analytical process, we knew that July, if it was going to collapse lower, that would have had to have withheld or withstood the time. And the reason being, there were 2 significant ratios which pinpointed that top. One was basically extending this original zigzag by 61.8. So I'm going to do that now, just to show everybody how that works. So there's that extension line coming in. And the other one is to extend, we take the inverse of the golden ratio, which is a 1.618, and we extend wave A of this expanding flat like this. And you'll see there's a second line overlapping it. And we've hit that pretty much consistently with so many other indices into that July high. Well, when we saw 3 waves down, we went through the whole process. Yeah. I mean, it's fairly automatic. So we say, right, okay, 3 waves down. Is that a correction, or is it a bearish 1-2-1 pattern? And as soon as we broke above this secondary high in July,
that's when you changed.
That's when we had to change. We said, no, look, if this is going higher, now we're forced to make the change. So it's fairly automatic, really. We've just gone through a process, a fairly rigid process. And so we haven't taken it lightly, and we haven't done it arbitrarily either. I mean, it's gone through various different gates and processes for us to then say, right, okay, we're going to have to adopt the expanding diagonal now, which rather looks like this. But the next question that we asked ourselves was that, okay, if we're adopting the expanding diagonal, and this is wave 3, these are the sort of minimum targets that we could expect for next year. Where are we in that process, which is this process? Now, we know that wave 3 of an expanding diagonal, it must unfold into either zigzags or double zigzags or triples. So these are the only 3 things that it can work into. It can't do anything else. So we have to work ourselves into some fib price ratio targets, and this one fits better as a double zigzag. But then the next problem arises. Some of the major indices and equities have dropped down from their July highs into 5-wave patterns.
Yeah.
And this is Alphabet Google.
NVIDIA? What's that, NVIDIA?
No, this one is Alphabet Google.
Okay, Google, yeah. And you were calling for 140 a long time ago. Almost got there.
Yeah, it got down to here, but I think it probably will get down to sort of something like 131 and return back to wave 4 preceding. In this case, okay, I think it could get down to 125. And the reason for that is because it has dropped in 5 waves.
Yeah.
So if you think about the dates when the stock market topped out in July, we've had the NASDAQ drop down in 3 waves. The S&P dropped down in 3. They're making new highs. Well, actually, the S&P, not the NASDAQ at the moment. But we've seen some equities within the mega caps, the mag 7s.
Yeah, yeah.
They've dropped down in 5 waves. So how do we reconcile that? According to, now a minor 3rd wave, which is going up next year to new highs. Well, if you take a look at NVIDIA, which is the next chart, you'll see that the correction down from this high at 140.76, we've labeled it as the same, well, actually as an expanding flat. A down, B that makes a new record high, and C down. So on the one hand, you've got equities like Alphabet, Google,
Yeah,
which we consider to be
they're put in
underperforming.
failing rallies. Some are even within the Mag 7.
Yeah.
There's you know, bifurcation.
Mm-hmm.
Even within the
Exactly.
7.
There's
Okay.
price
That's a tough environment, you know.
Yeah, there's price synchronicity. So in other words, you go up and down at the same pace, but the
Yeah.
amplitudes are different and they create the different patterns. So we see this a lot. So when we make comparisons with different stock indices across different global indices, or we might even look at currency crosses or pairs and make the same distinction, you'll often find that when corrections unfold, there will be outperformers and underperformers. The underperformers will decline into zigzags, so that the B waves never make new highs in that pattern sequence. But the outperformers will make higher highs as B waves, like NVIDIA will make a higher high because they're outperforming. Yeah. But they're still basically corrections, you see, and they're synchronized price-wise the same. They go up and down the same vibration, but the amplitudes are different, which creates the different patterns.
So tell me what you think. Here's my style. Looking at those two charts, I think that would be a tasty short up there. But my preferred short would be Google, because it's going to make a lower high. It had 5 down. I'd rather sell relative weakness than try and be a hero selling the relative strength. I'll buy the relative strength, but I'd rather sell the weak sister.
Yeah, so, exactly. Yeah.
All right.
Yeah,
so
no, absolutely.
That's probably a higher probability short because it's already showed its hand, right? And you also have a stop loss point that's very reasonable on NVIDIA. You could sell it at 65, and sometimes, you know, Peter, the rubber band stretches further than we think and takes longer than we think for it to happen.
Well, up here, you've got no stop loss unless you wait for the reversal signature to go downwards, and then you have to put a stop wherever the high is.
Right.
But of course, here, you have got a stop loss above 193. You know, risk reward wise, that's pretty good. You know, if you were to sell there. But what I would do to play that, and for anybody tuning in today, I never play these numbers. I mean, we calculate the numbers, and this is where we expect potential reversals, but we never play the numbers themselves. We wait for a reversal signature from the numbers to validate. And then when we go short, for example, if you want to go short this equity or something on the equivalent to, you know, the indices, then you wait for the reversal signature and then you put a stop above wherever the high is. But what's going to gain confidence in this forecast is if you get close to these numbers here, we don't break the highs. This does a secondary high, remains below the high. Meanwhile, this one breaks into a higher high somewhere.
You have some euphoria up there.
And then you see a synchronized drop where both give reversal signatures. Then you know what's going on. And you have a pretty good idea what to aim for as well. Because trading is not just simply about executing an entry order in something.
It's about managing the trade.
Yeah, because your survival in trading longer term will depend on your risk reward setups.
Yeah.
You know, it's simple as that. So you've got to know where your exit point is, or an attainable target that's realistic. I have to say it is realistic, because
there's a pro.
You know,
write these words down, everybody. That's an order. Peter, could we wrap it with gold?
Yes, we can. I think we're probably getting close to a top here. It looks a little bit stretched. We've got a 5-wave advance from 1810, and we're in the 5th wave. Now, I don't think we've got a subdivision of 5 waves from the last correction here at this period here from 24.31. Now, it's either a running flat down here for wave 4 to 22.87, or it finished a conventional small correction there at 22.78. Either way, we can't count 5 waves up. So we know that minor wave 5 from 22.78 hasn't finished. At best, we're in a 3rd wave. And there's been a denoted 3-wave advance so far in here. So we think that this is probably characteristic of a zigzag within an ending diagonal. And if that's the case, we'll get a fourth wave down to 2400 or thereabouts, and then we'll get a
Wow.
fifth wave up later.
Yeah. With the market.
Yeah.
So it's going to pull back with the market for a little bit here. That's a big break, though. That's going to break some trend lines for people.
Well, we've got
2400.
silver also doing a zigzag upswing from this
Yeah.
August low. And you can measure the quality ratio in a zigzag here, ABC. We hit it on Friday. It's come down a bit today. So I'm doing a little bit of a short position on that at the moment. But
okay.
Basically, if you look at the gold silver ratio and work out the numbers, you'll get an idea that gold should drop down to 2400 thereabouts, and then we can go from there. Yeah.
You know what, Peter? I talk about that it's all one market because for the most part, stocks, metals, the dollar, you get the dollar right, you usually get everything else right. It's all one market. They just go up and down with different magnitude. So it looks like, based upon what I've seen today, that when you have silver at 33.90 and gold after this pullback making a new high, and possibly the S&P up there at the same time,
Yes.
that just like the whole board has been along with dollar weakness, that
Right.
the whole market's going to take a pretty good breather.
That's correct. Yeah. So look at these. You're exactly right, Dale. I mean, look at these correlations, because I know it's a lot of work. I mean, we're doing a lot of the work for you. So you can basically, but you still need to do your own work. Take my key to trading is take always self-responsibility. Self-responsibility. Yeah. You do it in your own life. You do it in trading too. And that means you've got to do a little bit of legwork and look at cross correlations. Maybe, if you're a specialist in some different currencies, and you can see the correlations going on, and if you're a currency trader, that works that way too, in commodities also. But you can also apply it into the bonds or the stock markets, and just look at the more things you look at. Doesn't mean to say that you have to trade them all.
Right.
But the more things you tend to look at, and if you look at them in a specific way, you'll see these correlations. And it's very, very useful. I think actually it makes us all a better trader if we do that type of correlation work.
So are you saying, Peter, if you hear someone or me like right now say, man, that yen burned me, that I'm not taking responsibility for being wrong? Huh?
Yeah, you're not taking responsibility if it's because it's not.
I got burned by the. I'll never trade that yen again. It burned me.
Yeah, well,
I had to get one of those laughs out of you today. Anyway, Peter, your stuff, I rely on it. I love it, and I think people should get it.
Thanks a lot. Thanks for the plug.
Anyway, so why don't you show people how they could do it?
Thanks. Just briefly, this is the Elliott Wave Compass report. We publish twice a week. It's, I think, $39 a month. And so this is what it looks like when you download it. So you get all the charts and some running commentary. If you log in online, you'll see it a bit like, here's my attempts to get Zoom working. You'll see it a bit like this. Here we go. Elliott Wave Compass. And you can just go to the report and you can see it, all the charts online. You can either select them individually or see them as a grouping. But basically, if you scroll through, you can log in. You'll get access to this 24/7, of course. And you can download the reports from here. So that's one way of doing it. If you do go online, go into registration and subscription. Here's the subscription area, and you can see the Elliott Wave Compass report, and here it is, $39. So that's a good way really to follow what we're doing. And occasionally we are posting some interesting stuff on Twitter, not quite as often as many people would like. We're very busy in the office doing all of the other work, so the main thing is really to subscribe to the Compass report. But if you are doing it, and you've got questions, once you become a subscriber, and if you've got questions, ping us messages, because we're getting lots every day from the Compass community, and we're quite happy to answer your questions. Only so pleased to do that. Yeah.
Okay, Peter. I want to thank you. What do you think about the far right gaining some political strength in Germany?
Reading all about it in the Financial Times today.
All right. You live there and you rely on a UK paper to tell you about it?
Yeah.
That's good. All right.
It's a sad fact. But I do
Yeah.
go to the market sometimes. I had a very interesting conversation with two lovely women from Hanover, and in a cafe last week, and we did talk about it actually, but I'm not going to talk about it on air.
All right. Okay. It's like that everywhere now, Peter. It's such a toxic environment everywhere. And I'll say that on air.
Yeah. Well,
Toxic.
that brings us to a very, very significant opening. Not just, I hate politics, to be honest, because
Me too.
I just politics.
Be glad you're not in the U.S., man.
The flip side, well, I can see what's going on there, but the flip side to politics is religion. I'm not religious, but I am spiritual.
Yeah.
And the two go hand in hand as far as I'm concerned. I don't like politics and I don't like religions, because they are more separatist than unifying. But that's another story for another time. Maybe we'll do a separate thing on those subjects.
All right.
Analysis.
We don't offend people talking about the religion of money.
No,
and the worship of profits and the reaping like out in the fields of wheat, reaping in all their profits and putting it in their silo so they have enough for themselves the rest of their life.
Yeah,
right?
I know. There is that part to it too. Yeah,
there's that temple. There's that temple, man. Of mammon. Anyway, look, I have to get busy and make some money here, man. Anyway.
Yeah, let's get going. Let's get going.
You could tell I missed you. Great to hang out with you.
I miss you too. We haven't spoke for a while, so we've got to have a longer chat. So look, everybody tuning in today, thanks. It's really great to be able to show you everything going on here. And there's, we could talk for hours about stuff. But time limits and we need to trade. So good luck with everybody. Thanks for the invitation today again, Dale, and we'll hopefully catch up soon again.
All right, my trading warrior brother, Peter Goodburn. Find him at Elliott Wave_WTI on X and go to his website. Okay. Have a great day, everyone. Don't just count your wave structures. Count your blessings. See you later. I made Peter laugh a few times. That was my goal today. I feel rich. Adios, everyone.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.